Palantir Technologies isn't a household name, and yet, it's a company that quietly shapes the world behind the scenes. Its software powers the daily operations of governments, intelligence agencies, and major corporations across the globe, often without the public ever realizing it. At its core, Palantir is a data analytics powerhouse, building advanced platforms that help organizations sift through mountains of information to find hidden patterns, connections, and actionable insights in massive datasets. Its tools are used for everything from tracking terrorist networks and preventing cyber threats to managing global supply chains and accelerating breakthroughs in medical research. Founded in 2003 with early backing from the CIA, Palantir's roots run deep in national security and intelligence, giving it a unique edge in the tech world. Its two main products, Gotham, designed for government and defense applications, and Foundry, tailored for commercial clients in industries like finance, healthcare, and manufacturing, are now considered industry standards. After years of operating in the shadows, Palantir finally went public in 2020, opening its books and exposing its business to the intense scrutiny of Wall Street. Recently, Palantir reported its best quarter ever, record profits and revenues that blew past even the most optimistic expectations, making headlines everywhere. Normally, this kind of financial performance would send a company's stock price soaring as investors rush to buy in. But instead, in a surprising twist, Palantir's shares dropped sharply, leaving many observers puzzled. Why would a company's stock fall after such fantastic news? The answer reveals the complex and sometimes counterintuitive way the market really works. Stock prices aren't just about past performance. They're about expectations, future outlook, and the psychology of investors reacting to every new development. Palantir's story is a lesson in looking beyond the headlines to understand the deeper forces and hidden dynamics that drive Wall Street's decisions. Let's dive deeper into what happened, why it matters, and what it could mean for investors navigating today's unpredictable markets. Palantir's third quarter results were nothing short of stunning, posting an impressive $475 million in net profit, a figure that would have seemed unimaginable just a few years ago. The company also reported $1.18 billion in revenue, shattering previous records and setting a new high watermark for the business. This marks a dramatic shift from its early days as a cash-burning startup, when profitability seemed a distant goal, to its current status as a highly profitable enterprise with a strong financial foundation. CEO Alex Karp celebrated the milestone, emphasizing that Palantir now makes more profit in a single quarter than it once made in an entire year, a testament to the company's transformation and relentless drive. The company's remarkable growth is fueled by two powerful forces: rapid expansion into commercial sectors, where new partnerships and clients are driving demand, and surging demand for its advanced AI platforms, which are increasingly seen as essential tools for modern businesses. Palantir's software empowers organizations to deploy, manage, and scale AI models efficiently, making it a key player in the ongoing AI boom that's reshaping industries worldwide. The company's forecast for the next quarter was equally bullish, projecting even stronger sales and continued momentum, despite broader economic uncertainty and market volatility. Analysts at Morgan Stanley called it Palantir's fastest ever sequential revenue growth, highlighting the company's accelerating trajectory. The company exceeded expectations on every key metric: profit, revenue, and future guidance, delivering results that surpassed even the most optimistic forecasts. Palantir is capitalizing on the AI revolution and expanding its customer base at a breakneck pace, reaching new markets and industries with each passing quarter. By the numbers, this was a report that should have sparked a Wall Street celebration, with investors and analysts alike expecting a surge in enthusiasm. But the market's reaction was anything but predictable, leaving many observers puzzled by the disconnect. Why? The answer lies in the complex psychology of investing, where numbers alone don't always tell the full story. Despite the blockbuster report, Palantir's stock fell over 6% in after-hours trading. How could record results trigger a sell-off? It's all about expectations. Investors had already driven the stock up in anticipation of great news, pricing in much of the upside before earnings even dropped. When Palantir delivered, it met sky-high expectations rather than smashing them. For some, this was the cue to take profits after a massive run-up. This buy the rumor, sell the news dynamic is common with high-growth tech stocks. The drop wasn't a verdict on Palantir's future, but a reflection of market psychology and the high bar set for performance. Concerns about valuation also played a role, as some investors saw the stock as too expensive, even after strong results. In the short term, stock prices are driven by a mix of facts, emotions, and predictions. Palantir's dip was a classic case of expectations outpacing reality. To understand the market's reaction, look at Palantir's year. The stock soared 175% before the Q3 report. This meteoric rise was fueled by the AI boom and Palantir's positioning as a key enabler of the technology. Investors saw Palantir as a pick-and-shovel play in the AI gold rush, sending the stock to new heights. But with such gains, expectations became nearly impossible to meet. When the company delivered only excellent results, it wasn't enough to push the stock higher. The post-earnings dip was a minor correction after a period of breathtaking acceleration. For early investors, a 6% drop was a blip. For latecomers, it was a harsh lesson in momentum trading. Palantir's 2025 story is one of explosive growth and the pressure that comes with it. The Q3 report was where sky-high hopes met reality. The lesson context matters as much as the numbers. Wall Street analysts were split after Palantir's earnings. Bulls like Morgan Stanley praised the company's growth, profit margins, and strategic position in AI. They see Palantir as a foundational platform for the digital transformation of government and business. For them, the company's long-term potential justifies a premium price. Skeptics like Jefferies warned that Palantir's valuation was extreme, trading at a huge multiple of future revenues. They argued the stock price had outpaced the company's actual business performance. For new investors, the risk-to-reward ratio looked unfavorable at these levels. This debate is about more than numbers. It's about different philosophies of investing. Bulls focus on vision and growth, bears focus on valuation and risk. The result, a stock caught between optimism and caution. Palantir's growth is powered by two engines: its AI platform and deep government ties. Its artificial intelligence platform, or AIP, is now essential infrastructure for organizations deploying AI. Palantir doesn't build AI models. It provides the operating system that lets others use them securely and at scale. As AI adoption accelerates, demand for Palantir's platform is soaring. Meanwhile, its Gotham platform remains embedded in defense and intelligence agencies, securing massive long-term contracts. In 2025, Palantir landed $500 million in new government deals, underscoring its dominance in the sector. These government relationships are both a strength and a source of controversy, exposing Palantir to political risk. The combination of a booming commercial AI business and rock-solid government contracts gives Palantir a unique, diversified growth story. This dual-engine model fuels both optimism and debate about its future. The main concern for Palantir is valuation. By late 2025, its market cap neared $491 billion, putting it among the world's giants. Some analysts noted the stock traded at 83 times estimated 2026 revenues, an exceptionally high multiple. This means investors are betting on years of rapid, flawless growth. When a stock is priced for perfection, even small disappointments can trigger sharp declines. The AI boom has fueled frothy valuations across the sector, raising fears of a bubble. Palantir's post-earnings dip signaled the market may be rethinking these sky-high prices. The question isn't whether Palantir is a good company, but whether it's a good investment at this price. Amid skepticism, CEO Alex Karp remained unapologetic. In his letter to shareholders, he took a victory lap, addressing critics who doubted Palantir's path to profitability. On the investor call, Karp dismissed valuation concerns, blaming out-of-touch elites for missing Palantir's potential. His blunt message: "We were right, you were wrong." This confrontational style is classic Karp and central to Palantir's outsider image. He argues Palantir's value can't be captured by traditional financial models. Karp urges investors to ignore short-term noise and focus on the company's long-term impact. Whether this confidence is justified or hubris is the billion-dollar question. Palantir's Q3 story offers key lessons for investors, whether you're new to the market or a seasoned pro. It's a reminder that headlines rarely tell the full story, and that digging deeper is essential for real understanding. First, there's a difference between a good company and a good stock. Price matters. Even the best businesses can be poor investments if you overpay, so always consider valuation before jumping in. The market had already priced in great news, so the actual results didn't move the needle. Sometimes, even strong performance isn't enough to push a stock higher if expectations are sky high. Second, expectations drive stock prices as much as fundamentals. What investors hope for or fear can move markets just as much as earnings or revenue numbers. Third, know your investment thesis and time horizon. Long-term believers saw the dip as a blip, while short-term traders felt the pain more acutely. Your perspective shapes your reaction to volatility. Finally, Wall Street's divided opinions show there's no single right answer in investing. The market is a place of constant debate, and that's what makes it dynamic and challenging. Bulls and bears both have valid points, and both sides can be right at different times. It's important to listen, but also to think independently. The real takeaway: do your own research, know your risk tolerance, and look beyond the headlines. Don't let noise or hype dictate your decisions. Palantir's story is about more than data and AI. It's a lesson in market psychology and valuation. It shows how perception and reality often diverge in the stock market. The company's future will be shaped by both its technology and the expectations of those who invest in it. Both innovation and sentiment play a role in determining success. In the end, understanding the forces behind the headlines is what separates smart investors from the rest. Stay curious, stay informed, and always look beneath the surface.